Let's kick things off because we don't have a lot of time and a lot to cover. Thank you all for being here today. We have Will from Anrok. For those who don't know, Anrok is one of the premier, relatively new, but one of the premier and fast-moving companies that help all businesses with their essentially state sales tax, which, as we all know, can be a really complex and challenging area to deal with. So there are a lot of different topics we want to try to cover today. Will, why don't we just jump into these, and I will probably interrupt you at various points with questions as we go through.
So Anrok came to be, we're the sort of brainchild of Michelle Valentine, our CEO. We're about 3 years old, and it came about from a implementation of a competitor of ours at another high-growth SaaS company. And after a long process, they realized that that competitor simply wasn't solving their needs. And the reason that those needs weren't met were for two main reasons. SaaS taxability and digital goods taxability is a fundamentally different animal than physical goods or e-commerce, which has been around for quite a while as an issue. And the second is that complex subscription billing processes are fundamentally difficult to deal with and very different from how you interact with, say, Amazon.com and adding 8% to the receipt at the end of a transaction. So we've been around for 3 years. We're growing quickly, and we specifically target software in the digital goods economy and handle sales tax compliance end to end.
When our team or when a CEO and founder should actually be considering working with Anrok or even any of your competitors, like what is the trigger point when they should say, hey, like I need to make sure I'm handling sales tax properly?
We typically find that the most compliance forward companies are dealing with this as soon as they cross a revenue threshold, because it's easy to just start tracking your nexus and exposure. And then it becomes very important for CEOs, CFOs, strategic operational advisors like Levy, as you start to think about those big events, for your company that could really drive impact down the road. So some of the reasons that we see folks, look to deal with sales tax is around ongoing upcoming financings, M&A, the risk of audit, and really just flagging that these are things where every bit of sales tax that you're not paying today becomes a liability on your books down the road. And so if you have a company that is selling for 11 million EBITDA, but you have a $500,000 sales tax liability, that's going to come right out of your acquisition multiple. And so it's important to deal with upfront.
You're selling your software in X state, let's call it New York or something to make it an easy state. You're selling your software in New York. You're not collecting sales tax. You will owe that in the future, but because you've not collected it from your customers, it's going to come out of your own cash reserves, basically.
If you've triggered a sales tax obligation because you've crossed nexus, so in the state of New York, I believe it's in a couple $100,000. In other states, it's a certain number of transactions. Every transaction from that point onwards, you will have to pay it whether you collected it from the customer or not, and that will become a liability on your books.
But what are the key elements that help you figure out when you actually need to start doing those collections and how much you should be collecting, right? Like, because sales tax is different in every state, every jurisdiction is different. So how much you actually charge your customers for your product is also different. But when should you start? So long way of saying it, should I start doing those collections immediately the moment you start selling in a state and just say, look, we're going to add 6% sales tax to every sale we make just to be safe? Or how should a company be thinking about once again when to start, and then how to figure out when they actually really need to owe that money to a state?
Well, the good news is you don't necessarily have to pay for Anrok to just start. You could integrate with QuickBooks and you start monitoring. So, we offer, through partners like Levy, you can integrate with the Anrok software, and you can just track your exposure at no cost. So you can just get that monitoring and see how you're, working towards those thresholds. So that's a big thing. But yeah, in general, I think if you want to take an even, quicker way, you say, well, what states am I operating in? If your entire business is in California and you're selling software, then and you're selling one product, I think you just watch, when did we move out of state? When did we hire someone out of California? But if you're a multi-product business, you have a little bit of SaaS, a little bit of professional services, maybe some digital goods, multiple employees in different states like Texas, New York, Washington, then you probably a lot earlier on, want to be running the integration and seeing, how are we exposed?
Target really quick, but does it make sense for a company to just say off the bat, just to recommend, should we be recommending to our clients who are SaaS businesses, just hey, no matter what, just to be safe, start collecting, just add a 5% tax line item to every one of your invoices, just to be safe and collect that money? Or is that still not something worth, let's say your bill is $1,000 a month for your software. Should you put 5% tax line item on that just to be extra safe? Let's say you're monitoring with Anrok, but maybe you haven't started monitoring yet. Should you just put that onto your invoice just to be safe?
I hate to give you this answer, Adam, but it depends. And I'm not a tax lawyer. But I would say you probably can't apply just a unanimous rule. We should just start charging 5% right out of the bat. Because I do think there are some liabilities from misrepresenting tax collection as well.
How do we define nexus? How should people be thinking about that? Walk us through that part.
So nexus is defined in two primary ways. One is economic, so that's how your sales have grown over time in a certain jurisdiction and how across the threshold. And you might say, well, what's a jurisdiction? It's not just 50 states. It's actually every county and zip code can have different rules. So some are tracked at the state level, but some are tracked at the county level, and you need to make sure you're complying with both. The second is physical nexus. So that's where an employee is. But oftentimes we get questions, well, what about an independent contractor? What about a PEO style, employee? PEO employees count, absolutely. Independent contractors, it depends. So if I'm an engineer or a salesperson who's really very involved in the weeds of the business, I would say the answer is it depends, but oftentimes that is the type of employee who even as an independent contractor could trigger nexus. So there's a lot of ways that you can, flip a switch, but the two things to think about is where are my employees and what are my sales in taxable states?
What are the sort of triggers for nexus? Would it be I have 2 employees or contractors in that state and I've sold at least $100,000 in software this year, and then all software sales over 100,000, over 100,000 is when I'm starting to collect that tax? What are some examples so people can kind of make this more real?
California, if we're talking a software product, SaaS is a software as a service, there are no transaction thresholds because they don't tax SaaS. New York, they do tax SaaS. And so the two things you have to trigger on an economic side are my sales over $500,000 and am I making over 100 transactions a year? Once you cross those two, then you've tripped it. But there's some jurisdictions where it's just a transaction account. So you actually could have a very small B2C seller who's just selling lots and lots of App Store, licenses. And then in others where it's $100,000, which depending on the type of company you are, you could trip in one invoice.
Got it. So, and then once you've hit that threshold, that's when you need to start collecting any transactions or whatever over that number is when you start collecting. And part of the challenge, from what my understanding of the system and how it works, is every state has different rules. And therefore, it's almost impossible without software like Anrok to know when you've hit nexus and need to start collecting, number one. And then number two, how much to start collecting, because the actual taxable amount is different as well in every state. Is that right?
Yeah, no, it's accurate. So we have 50 states and then, dozens and dozens or maybe even thousands of jurisdictions across the United States with their own rules and regulations. And those vary across each product code. So software as a service, packaged software, infrastructure as a service, professional services, those are all different tax codes. So the number of data points that it could be, grows into a pretty large data set to choose from extremely quickly. And so if you are, a small team selling one product in one state once a year, yes, you could probably go online and look it up and like add it to yourself. But if you're even a small size business, but with multiple products in multiple states, it quickly can turn into hours of work. The other thing though, is if you get it wrong, the risk of audit or unpaid liabilities and penalties can grow pretty quickly. So if I'm a $1 million business, or let's say I have a $500,000 sales tax liability, but I'm growing 300%, which is very common amongst high growth tech companies. The next year we could have a liability in the millions of dollars, and so it pays to get it right from the get-go.
And the reason it pays to get it right, just to maybe reiterate, hit the point, it's because if you don't get it right and you're not collecting sales tax, it once again comes out of your actual revenue, whereas otherwise it would just be added on to the bill, right? So anyone who's shopping, we've all done online shopping, in most cases, there's a tax that's added to your bill before you check out. And for most of us, it's sort of just like, yep, okay, I get it, it's a tax. I pay that as the buyer, and then it's added on. And then of course gets remitted to the state. So it's not, but otherwise, if you don't collect it, but you do owe it, then you have to pay it out of your own cash reserves.
Out of your own pocket. And then the other thing is, it's sort of like when, legal cases go awry, if you are dealing with an audit or a major sales tax obligation, there's a lot of legal processes. One, if it's a small number, you can just, file historically. If it's a big number, you have to go through agreements and processes with the state where you need to get accountants and lawyers involved, and the professional service like cleanup fees will go into the tens of thousands of dollars from even a relatively small liability.
We talked about SaaS. Are there services side things they should be considering? I know Anrok doesn't really focus on direct to consumer type work, but like are there things that just from a general perspective that our clients should be thinking about, since Levy works with folks across the board?
Yeah, exactly. I did want to cover sort of the SaaS, digital goods, e-com services, because I know that with you guys, all of it is relevant. And so I think the first thing to think about is, what is like physical goods, e-commerce. So physical goods is just anything tangible. Can I hold it in my hand? And so if I'm a D2C website and I'm selling pillowcases, that's absolutely physical goods. Now, I could be e-commerce and be digital goods if I'm selling audiobooks, podcasts, digital photography, NFTs even count. And those would be digital goods. And those are considered separate from SaaS, which is like software as a service, downloadable software, on-premise software. And then you brought up a good point around professional services. So professional services are almost always not taxable, although they are sold alongside these products. And so they would not be taxable, but you still need to sort of process them. And then some companies that are purely professional services typically don't need to worry about this, because they just can say that they're not taxable at all and not be too worried about getting audited.
It's still worthwhile for them to sign up for Anrok sort of free service to just track this, just to make sure, because once again, every state's a little bit different, things like that. Is it a useful thing for every company out there who might have liability, which once again, if you're actually having some revenue and selling stuff, you might have liability, to sign up for Anrok's product to just monitor? Is that a useful thing or not necessarily?
SaaS digital goods side, absolutely. In terms of just what we cover today for an e-commerce company in the physical goods space, that's not our bread and butter. And then if you're a pure play professional services firm, and I don't want to speak to exactly what Levy is, because you know it better than I do, but you guys probably do not need to worry about sales tax yourself as a, consultancy.
It sounds like though there's still, because of what you guys are offering, an opportunity that this is just a good recommendation for every startup. If you're, once again, as long as you're a SaaS company, to sign up for Anrok, because why not? This is just good to monitor and make sure you're not missing stuff. And the cost is your time, or in this case, Levy would help you do it anyways. It'd be Levy.
Yeah, if you're a Levy customer and you're on QuickBooks, Xero, you're already on that tech stack, to just start tracking your sales tax exposure through Anrok, is an extra 25 minutes of your time, and probably 15 because Levy's there to show you the way.
Just in relation to professional services. So Anrok will track, say my client offers a professional service, and Anrok will track in what state that professional or jurisdiction or county that professional service is taxed. So for example, if their service is something like therapy, like does my client need to know if that's taxed first before using Anrok, or will Anrok help with figuring out if that needs to be taxed or not? Does that make sense?
Will Anrok help with the taxability assignment of whether their therapy is a service or not?
Yes.
Yes. So we have guidelines, and we can sort of point you in the right direction. Ultimately, it is up to the client to make like a final determination to their own taxability. With that said, the rules around professional services are pretty clear. And, I would say like a therapy business is not the first to ask this question. And so it's like fairly cut and dry, but yes, ultimately the client makes that assignment.
The way this works, from what I understand, is it depends on how your accountant and bookkeeper is tagging your revenue. So if your revenue is defined as professional services within your balance sheet and P&L, that is what then Anrok would pull in as the legal determination by your bookkeeper of how you're categorizing your revenue. And then that is what you'll then decide. Do you have nexus? Does the state tax that professional service or that other product you're selling as well? So I'll give you an example for one of my clients. They have a e-commerce product and they have a more digital product as well. And so those are defined differently on their by their bookkeeper. And so there are different tax liabilities related to each one. But then they need a good service, like Anrok or one of the other companies that are out there, to help them decide, hey, how much is really owed in these states, and then how do I even remit? So that's actually another part I'd love to talk about as well, is help companies. Okay, you decide, hey, look, you owe $10,000 to the state of New York for taxes due to the products you sold. Do you then help the companies remit that money to the state, or is that done separately? You're just saying, hey, you're flagging, we believe you owe this.
Yeah, great question. So Anrok is full stack. It's end-to-end. And so it starts with the monitoring, and then we will flag where your exposure is. And so, Leon, just in your example, like we would separate the two. So there would be for instance, Washington State, professional services is not taxable, SaaS is. And so we would take, say, the $100 of SaaS, count that towards the sales tax obligation, and we would ignore the professional services while still tracking it, but ignoring it from a tax perspective. Once they've crossed a threshold, then Anrok would make it easy, like in a few clicks. You could say, like, register, make that determination, and then we would handle the registration process with the state. And then at that point, once you're registered, that's when you would now start adding it to the invoice, at the time of billing the customer. And so, that platform or the client of yours would then start adding the, 6%, 8%, it, depends on the area. And then we absolutely handle all of the, monthly or quarterly returns and filing, and, ultimately taking it from your customer's bank account and filing it to like the state tax bureau.
So just to make sure, I'll restate that for you. So basically, you would monitor, say, okay, look, you've hit nexus now. You owe 8%. You need to start collecting 8%. Then the customer manually adds that 8% tax line item to their invoices, via whatever tool they're using. They start collecting that money. That money goes into their company bank account. You then automatically pull that money from the bank account on a monthly basis or whatever the correct timing is. And then you help remit that, make sure that gets remitted to the state itself. Is that generally the flow?
Yeah, one big correction though is there's no manual adding the 8%. So, Anrok would integrate with QuickBooks in this case, or Stripe or ChargeBee or something. And we are automatically, when you create an invoice, we will automatically now add the tax rate.
Got it. So you add the tax rate, that's great, but then it's still collected by the company, and then you pull that money from the company's bank account to make the payment to the states.
Yes, but that's all, it's like relatively automated, technically unregistered, but it's a very laborious process. And, states frankly, to have the line of sight into what your business is doing. So they create lots of like caveats to the deregistration process, and that like you have to have no business activity for like a certain threshold of time and things. So it can be done, but like there's a high qualification bar to deregister and hence remove nexus. But you could file a $0 return. And so one of the nice things about Anrok is that we don't charge per return. And so, if you need to file $0 returns, it's not, adding to your cost.